Breaking news, guys. Mortgage interest rates continue their downward trajectory this morning, even in the face of a much hotter than expected inflation report, core PPI. For those of you guys that don't know me, my name is John Cams. I have been a mortgage loan officer for going on 25 years. I help people every day on this app buy, sell, and refinance homes. Let's go ahead and get into this. The core PPI, which strips out food and energy, rose a whopping 0.8%, which was over double the expectations of 0.3%. We are in somewhat of a bizarro world with the market as far as interest rates go, because usually a hotter than expected inflation report would cause interest rates to rise. Interest rates are a fixed income asset, so when prices on goods increases, it erodes the return to that investor on that fixed income asset. And the only way for the investor to compensate for that is to increase interest rates. However, the market is concerned with stagflation, which is when prices are rising, even in the face of slowing economic growth. There are also rising fears that AI will lead to massive job losses, which is exacerbating the fears of stagflation. This has caused a sell-off in the stock market, with the Dow currently being down 635 points, and it appears that money is flowing into the bond market. You have the 10-year Treasury breaking below the psychological 4% threshold. Over the past 2 years, every time the 10-year Treasury has dipped below 4%, it has been very volatile and short-lived. The longest period over the last 2 years of the 10-year Treasury being below 4% was August of 24 to October of 24, so only 60 days. This time it appears to be different though. If the 10-year can close below 4% today, even in the face of a much hotter than expected PPI report, this could point to interest rates continuing to come down. We also had Fed Governor Miron state that he thinks interest rates should be cut 0.25% 4 times this year, and that those cuts should happen sooner rather than later. If interest rates can continue to stay at this level or even decrease for a prolonged period of time, say 6 months, then upward pressure on housing pricing is going to increase. The reason I say this is that buyers need time to realize that rates have come down. They then need to get pre-approved. They need to shop for a home and close, and this is a 2 to 3 month process. And since rates spiked in 2022, we have not had a prolonged period of time where interest rates were in the 5s, which has muted home appreciation. If you're in the market to buy or refinance a home and you have been waiting for interest rates to come down, then this could be the perfect time for you. But don't wait too long, because this could be very short-lived, as we have learned over the last 2 years. Also, as a buyer, you want to gain appreciation, not pay for appreciation, which could be the case if you wait too long for interest rates to come down and you walk into a much more competitive market with lower interest rates. I hope this helps, and as always, let me know if you or anybody you know needs help buying, selling, or refinancing a home. Make it a great day.